Hello, I'm Ted Seides, and this is Investment Management Operations. This show explores the inner workings of the most sophisticated institutions in the industry. Through conversations with executives across operations, compliance, legal, and finance, you'll hear how key operating partners run their businesses in an ever-changing and complex investment landscape. You can join our mailing list and access Capital Allocators content at capitalallocators.com.
I'm Scott McDonald, and I'm your host. This sponsored insight features Hank Boughner. Hank is the CEO of Dynamo Software, an end-to-end platform for the alternative investment industry. Hank has been the CEO of Dynamo since 2017. His unique career path as an engineer, investment banker, and private equity investor gives him a unique perspective on what the future holds for investment technology. Hank shares his insights on why software verticals are consolidating, single point versus platform solutions, and why he believes that platforms will win over time. We also discuss the importance of brand awareness, advice on user adoption, and his thoughts on the implications for incumbents and new entrants with M&A activity. Please enjoy my conversation with Hank Boughner. Hank, thanks for joining me today. I'm excited to talk about all things technology. One of the things I want to explore with you is just your building blocks and how you found your way into the role of CEO at Dynamo. And could you tell us how you got there?
Yeah, thanks, Scott. It's great to be with you today. And I've been at growth equity and growth and fintech and software for 25 plus years. And so with age comes a certain ability to look backwards and see the arc of your career. And it pieces together in certain ways that maybe as a younger person in your teenage years you wouldn't have seen. I certainly have enjoyed that aspect of reflecting on my career as I share it with my kids and others of how to build successful platforms or build what you want to do with your life. At the core of it, I've always been in and around three main areas: finance, technology, and capital. And all of those three come together to really be growth drivers. And so I like to think of myself as a driver of growth. And I did grow up a fair amount around technology. I grew up in East Tennessee in the late 70s and 80s. And my dad worked at Control Data, so I was familiar with mainframes and how those might work with punch cards because we'd practice on them from time to time. And my mom, although she was an English major, very focused in technology as a hobby almost. And at one point, she was a MCSE, Microsoft Certified Systems Engineer, but always interested in tech. And so she'd bring things home or work on items. In particular, at one point, she went out and bought a compact portable computer. They would look like suitcase size, green boxes on the left, keyboards that plugged in. And it was really fascinating at that age to spend time going through games, coding, programming that may make sense. I also had an AS400 for the Atari fans, peanut butter proof keyboard, but also in addition to games, the cartridge you'd slide in with BASIC on it, and you'd start programming to get the computer to do things like, I don't know, draw a red line that went across the page. Started off with very simple things, as you might imagine. So I do appreciate that background of when I grew up and my parents just naturally being interested in tech. And that stayed with me for most of my career. When I graduated college, I did major in finance and business. I'd always had an interest in that as well. And so one of my first forays was in the investment banking side. As I look back past that arc, I see banking, I see investing, and now I see a driver of growth operating role as CEO. But in the banking phase, I spent many years figuring out how to value things. And one of the early parts of that was as an analyst at Houlihan Lokey. But we spent all sorts of hours debating valuation metrics. How do you do a terminal multiple? What's the appropriate discounted cash flow model? What business model fits this? How does it fit into cash flows, income statements, balance sheets, and the like to be a real growth driver of a business? And so I thoroughly enjoyed that. At some points in your career, you feel like you're pushing uphill. At other times, you really get a sense that you're swimming with the river. It starts to flow. That carried on into my business school years and deciding to continue on with investment banking, where I joined Goldman as an investment banker in first the fintech group, and then as they formed the high-tech group in the mid to late 90s, it became really the boom years of the internet age into the early 2000s, which was very fascinating to see all of the different perspectives, all the information flow that was coming in and out of Goldman about deals that were happening on the West Coast and the Valley. We were out there all the time, up in Boston, New York, over into Europe and APAC. Really interesting, fascinating time. And that's another perspective with age and that arc you'll find sometimes in your career things are moving a lot faster than at other times in your career. And that particular point in time for 6 or 7 years, the market was moving very rapidly. And that, of course, inures to your benefit. It makes it very interesting to be a part of that. At the same time, as we were doing multi-billion-dollar deals and thinking about how to do add-ons for different companies, I realized valuation was an art. It wasn't just all about eyeballs, that you had to think things through about how you could drive valuation, how you could grow things. And in particular, got a bit of a nagging interest of, man, I'd really love to start investing in these companies and put these together from an investment perspective. Again, combining capital, combining fintech, financial services that I really liked, along with a core technology component. And so I did shift. I made the shift over to the investment side, which was a lot of fun. In particular, 2 platforms. I invested with Goldman for a number of years, and one of their strategies in high tech and venture capital. And that's really when I started to think a lot about this alternative space as a growth engine, because Goldman would not only do the normal private equity deals or growth equity deals, they were also expanding into secondaries deals, different debt facilities and capabilities you could put into companies, LP interests, a whole host of co-investing, direct investing that could go on. And so I was very intrigued by that. And so much so that I joined another firm when I left Goldman, HIG Capital, large private equity player now. At the time, many years ago, it was focused mostly on lower middle market buyout, which was a great market. They did exceptionally well. And it was really interesting in alternatives because private equity had grown from where it was in the 90s and into the 2000s to where people were starting to think maybe private equity and venture and growth could be much broader. And that's what we see today. If you think back to, for example, Francisco Partners 15 years ago, back when they started in the early set of funds, they were mostly focused on a single strategy, software primarily, a couple of funds, and one office location, which was San Francisco. Now, of course, they've expanded quite a bit since then. Same with HIG Capital, lower middle market buyout, a lot of success, and realized, hey, we could expand both in the types of strategy that we have, as well as the locations, whether it's in Europe, different parts around the world, to deploy capital. And it really was the dawning of this large movement of capital that started to come into alternatives, oftentimes from the public markets. And so I found that very interesting. So much so, again, as I've mentioned, I had this desire to continue to build and drive growth. And so I made the third shift, which is into more of a driver of growth role, a CEO role, or kind of operating roles, however you want to characterize it. I'd been around these types of companies for a large chunk of my career, and I thought it would be a lot of fun and very intriguing, in addition to just the fun part, to drive into my 40s and 50s and 60s to be able to have a software company, drive organic growth primarily, but add to the platform through acquisitions, which I'd had a fair amount of experience with, where you tuck in acquisitions to expand your product footprint, but you're really driving the top line organic growth for 85-90% of what you're doing. And so I'm now in my 7th year as CEO at Dynamo, and I'm very thankful to the team, of course, for that.
It's exciting. It's great to hear the arc of that journey. But also, you've been there 7 years now. And when you reflect back on that time, what was Dynamo like when you first started? And maybe take us forward a little bit.
I showed up in 2017 to start having discussions with the private equity backers and the founder, Krasen Dragunov. He founded the business with another fellow and a small investment from a retiree, essentially. And 15 years in, they'd done a great job of building, particularly Krasen, getting it to a certain point. At the time, we were less than 15 million, 20 million of revenue, and we had 60 or 70 employees. And so when you look at that type of company, one of the interesting things that you see in software is, it's one of the truisms that it's very hard to break through the 10 million and then the 20 million revenue milestones. And there's a variety of operational reasons for that as to why those are difficult junction points, particularly if you're in a vertical application versus horizontal. I did read Frank Slootman's book, Amp It Up. His strategy around a lot of growth and amping it up was largely around horizontal plays, which have a lot of applicability, of course, if you have that kind of play. We're more vertical play, and given my fintech background, financial services experience base, that shouldn't be a surprise. And so the question is, in that kind of market, which has a lot of growth opportunity, how do you position yourself to become 30 million of revenue, 50 million of revenue, into 100 million of revenue plus? And so in the early days, a lot of discussion around, number one, did the market look attractive? Per my comments earlier, was there a swing to the alternative space that I understood, number one, and two, that would be interesting for me to pursue a strategy with a team and build around? And Dynamo fit that. Two, I would say Krasen is a very solid, logical founder. He came over from Bulgaria when the wall came down, was working at a PE shop in Boston in the IT group, leading a bunch of efforts, and said, hey, you know what? I could build a lot of this as a company. And so that's what he started to do. And so that ingredient was really good in terms of being with an operations-centric, growth-oriented founder who importantly was willing and able to work with others. He's a very logical person, and so is the rest of the management team, where we all get along well because we know where our strengths are, and we also understand, hey, maybe that's not my best thing. I can leverage someone else. It's an incredibly important dynamic, and why do I say something that often would sound so obvious? Well, as CEOs coming into organizations, one of the biggest blow-up points is the first 18 to 24 months, the founder and the new CEO don't get along for whatever reason. The chemistry is not there. The founder thinks it should go one direction. He or she's been running the show for years and years. This new highfalutin CEO comes in and drops all this new stuff on me. Or the CEO comes in, is too presumptive, too obnoxious, not willing to learn and interact with folks. So that worked really well for us. It has not only initially when we were smaller, but as we've scaled to 400 plus people today, that we're a medium-sized software company, one of the larger ones in the fintech alt software space. That has been a very strong dynamic for us. And along the way, of course, we've gone through a lot of growth pains. And I still joke with the management team about that. At one point in our career, when we were in that 10 to 20 million revenue range, it was a different set of growing pains. Where could we find talented people? With the team that we had, this may have been the biggest job operationally that they'd ever had. Quite talented people, but did they know how to go from 15 million of revenue to 30 million to 40 million, et cetera? And that's a scaling question that you and the team, as CEO, you have to lead the charge, have to figure out or help people adopt to a bigger mindset. One of the things I've always found humorous is I was traveling overseas with one of our team members, and we were talking to one of our technology folks, and this person said, well, we're just little old Dynamo. Who are we to think we could think this big? Now, this is years ago, but this is a very common thought. Wait a minute. We're not this big software company or medium size. I knew us when we were back with 5 people or 10 people or 15 people. And so that's part of the mindset that you need to work your way through with individuals and encourage folks, not jump on them or say how disappointed you are. Just like your kids, you can't just be negative around them all the time. You try to be as positive as you can to reinforce behavior. And sometimes it's challenging. As a father of 4, it's not always easy. But you try to reinforce this is what we can become. Let's set the goal really high. Set audacious goals to go after. And that's very important at that early stage to start getting people to believe in themselves that they could go do something like this, which I think we were fairly successful with. And we had a lot of help in partnership with Francisco Partners. Private equity firms can bring a lot of value. They're not too heavy-handed. They are strategic and strategy-oriented by nature. They do a lot of software, which was really helpful, particularly on the operating side. They have Francisco Partners Consulting, which does a really nice job of coming in and helping us augment where we need help, whether it's at the executive level, the hiring level, sales level, ops level, whatever the case may be. But they're not too heavy-handed where they're coming at us daily and weekly. So they gave us room to grow. And that's been maybe one of the third ingredients that's been really helpful. And fourth, of course, you got to have a good product. Probably underlying all, you got to have a product that works. And ours does. We're a multi-tenant cloud software platform solution. We moved into cloud in 2006, 2007. We started off on-prem. But the technology team and Crass and the management team determined at that time it would make a lot more sense to be cloud. So we've been doing that for 15 plus years. That in itself has been an interesting journey because back in the mid-2000s to 2010 frame, 2012, no enterprises would talk to the cloud in large part. Very few would. They wanted to do it inside the 4 walls, thinking about control, how do we manage security, how do we manage all the user interaction, et cetera. And so most of our customers at that time were small to medium-sized managers or small to medium-sized investment entities that would trust the cloud and knew that it would be very helpful to grow alongside of a vendor that focused just on alternatives. And so to answer your question on growth and stages, that's one important tack that we did make 15 years ago that still benefits us greatly today because most of our business, 90% plus, is in multi-tenant cloud settings.
When you think about the cloud, one question I have is, did you wait for others to actually go first and then follow, or were you guys actually earlier in the adoption?
Well, I mean, you can't get around what Salesforce had been doing for years, or Google or AWS were starting to think about to do. So I wouldn't say that we were on the bleeding edge, but we were certainly early. A lot of folks now are even struggling with, is it on-prem? Is it SaaS, which is basically just an on-prem setting inside of your own instance with your own database, and you have the same refresh rates that you have to go through and upgrade cycles you have to go through in that versus multi-tenant cloud, where particularly at the app layer, the application layer, you're able to manage interactions with users, manage our upgrade cycles a lot more efficiently. And then so when we release something, say over a Saturday night or a weekend, it's available to everybody on Sunday morning. And so that's one of the huge benefits of cloud is you get these scale economics and the scale synergies that you just don't get in the on-prem world. It's been helpful to have AWS driving a lot of this, Azure and others. It really has helped application software companies like ourselves scale dramatically because the mindset of the enterprise is, okay, we can go to the cloud now and it's safe and we can get the interaction that we need and we can configure it to what our users want. That's always one of the big pushback points from customers is we want to customize it to exactly what we want to see. Well, I get customization. There are helpful parts of customization. We happen to be big fans of configuration, which is end users can configure things the way they want it to look in Dynamo. And that helps with the refresh cycles. It helps us keep the technology current. And it certainly helps our customers get up to speed with how their users want to interact with our software.
I want to go back a little bit and dig into the vertical piece, but you also hinted at the horizontal piece with Slootman.
Yeah, sure. And I don't know Frank Slootman. It was just, I read his book. He was at a conference. It was a Francisco Partners conference. He was the featured speaker. And of course, he had 3 huge home runs. And he came from a product background. We started with data domain. This was the data backup to tape. So you used to tape, and you have tapes that would move off site, and you'd keep them in case something burned down. You'd have the backup tapes. Well, they moved things off of tape, and they started to come up with logos of, this is why we hate tape. And that was part of their marketing campaign. Then he moved to ServiceNow. And ServiceNow was, again, taking a horizontal layer, just like data is a horizontal layer and backup recovery. And here it was for tickets, the help desk tickets that would come in. And most folks were dealing with these through Excel and Outlook. How do we handle all this inbound of tracking? People emailed me something. Now I've got to track it. And so they did a great job on not only starting with that, but then starting to take in certain other areas of the back office of the tech stack that tech operators were having to deal with. And so then the third layer he came in, which everyone's talking about nowadays, was Snowflake and the data management in the cloud and how you make it so much more accessible, the refresh rates, and where as you drive to more and more data, you got it out of the mindset of the databases and the data warehouses and into the cloud models and how to re-architect that. So those were horizontal plays that would apply to anyone. The database strategy with cloud could apply to any market. And then you shift into vertical markets. Maybe it's a vertical market for the chemical industry or vertical market for a particular manufacturing industry. Ours happens to be a vertical market, which is alternatives. And so what we build in alternatives are front, middle, and back office software capabilities for general partners that would invest capital on behalf of, over on the right side of the coin, the limited partners. They're deploying capital at an increasing pace, by the way. This is north of $20 trillion market now, and it continues to grow at a very rapid pace because a lot of those investors, maybe they're not happy with the public market opportunities or the fixed income capability investment opportunities they have and are deploying more capital into alternatives where there are just billions and billions of investment dollars going in to private companies. And so our software is configured for that market. And there's others in the space. It's a large growing market. Of course, it attracts a lot of attention. And it's an interesting area, which I've always been fond of. As I mentioned earlier, Scott, I like to find those markets that I find something that I could bring to bear, It's much more difficult for me to go be an AI chip developer because I have no background in that, although that's all the rage right now. But as you move to financial services and how capital is deployed, marry that up with technology, it's right up my alleyway and others and say, yeah, this is a fairly sizable market. So that's a vertical market where it becomes very interesting to spend your time and figure out how you can help customers be successful.
There's been a fair amount of activity in the M&A market. Is this something that's just leading us into more vertical integration of all these singular pieces of software in order to create something similar to what you've built?
Yeah, this is pattern recognition that you have over years, and pattern recognitions don't always apply. But one near truism, let's say, is that software always consolidates. There are going to be emerging leaders in any category, whether it's a category killer, a category leader, or a company that's in a prominent position. And back to my comments earlier of, well, there's always going to be a handful of companies that are struggling to get from 5 to 10 to 20 to 30 to 50 million of revenue because it's difficult. And a lot of times the founders may have a great idea, for example, but it's hard to manifest that onto a larger company. And so you find what often is referred to as point solutions. Maybe they do a particular point product really well, maybe a specific function that is very unique to them and they do it better than anybody else, but it's hard to grow past that point. It's hard to develop outside of that. And that's what fuels the software market. So therefore, I'm a big believer that, yes, acquisitions will always be part of software. It's a very active segment of the economy, both from a banking standpoint. The bankers are always putting deals together. From an investing standpoint, investors are always finding ways to invest, whether as a private equity investor or a growth investor or on an individual basis. Invest in individual companies. It's fascinating. It's a lot of fun to do. And then to running companies. So I think that bodes well for software. The M&A market will always be there. There are always going to be very large, sizable software companies, multi-billion publicly traded ones, as well as ones like us that are backed by PE firms, where we have enough liquidity and capital given our backers to where we can do acquisitions as well. And so we've bought 5 or so small companies over the last 6.5 years, call it, and that has augmented the platform that we have and what we're able to do. And so I think that for those in the industry, I'm not surprised at all when you wake up and you see another company has been bought in software. It's just part of the world that we're in. And I often will joke with folks. I will say, listen, as a growth company, we get the joys and the pains of growing 15%, 20%, 30% plus, depending on what cycle we're in. We're profitable. But we also have the pains of that fast growth. And there are a lot of them. Things go wrong. Things that we launch in product didn't work the way we wanted it to. And so we got to go fix it. And on the infrastructure side or scaling the management team. But I find that far more interesting, and that's where most of the software world is, versus other industries that I call GDP plus. And there's nothing wrong with these. It's just, where do you like to orient yourself? A high growth one, or do you like more of the certainty, more of the trajectory of a GDP plus 2% growth company? Maybe it's growing 3 to 5%. Maybe it's growing 6%, 4%. And those are great businesses, oftentimes a lot more sizable than we are and a lot bigger than we are. But it is a little bit different orientation. And so I like to crystallize that with folks and say, you need to decide in your career what you're more comfortable with. And some folks aren't comfortable with that high growth environment. They get very nervous in it. They don't like the grayness. They don't like all the decisioning. But again, I try to coach where it makes sense, be a player coach without being too up on the soapbox pontificating.
There's trade-offs on buy versus build. And so how do you think about, you look at a company and you say, well, that's really interesting. Can we build this? Because the challenge of integrating that acquisition into your own platform is really hard. How do you think about those two pieces?
It's a really thoughtful question, because first we'll start with the easier ones at the high end because they're so complex, which is if you do a merger of equals, let's say you're worth $100 and they're worth $100, so now you're worth $200. You have two organizations coming together, which is quite challenging operationally. And there's a lot of headbanging that goes on in those kind of situations. Most of those are larger corporate deals. In our world in software, they tend to be, at least in our instance, small to medium-sized businesses that we're pulling in to Dynamo. So what's important to us is, one, we ascertain, have they built something that we could do? Because if you ask 10 of our developers if they could develop something, the answer is going to be 9 out of 10 said, yes, we could go develop it. So the question is not whether they think they could go develop it, because we have very talented folks, but how long would it take to develop it? And my general philosophy is, people get this wrong most of the time. It always takes a lot longer to build than you think. So if someone says, well, we'll implement this or build it in 18 months, it's going to take longer just to work the kinks out, even if it's an extension of what we do. coupled with the fact that people often forget that they have other product roadmap duties they got to fulfill on. And so we already have a product roadmap full of things to go build. So one of the questions we have frequently is, how will this impact our existing roadmap? And then third, you hit on the integration side, which is a key component, because I like to integrate businesses. We have a swim lanes process that we run, weekly meetings, pre the deal, post the deal. They can go on for a year. Everyone has to come. You don't get to go, oh, I'm so busy, I don't show up. They're Friday mornings most of the time, 9 to 9:30, something like that, depending on the time zones that are calling in. But it's that discipline that you need to have, because otherwise you start turning into, well, people didn't get the full scoop, or I'm too important to come to this meeting, or one of the worst corporate speak words I just don't like very much, my understanding was, which means you kind of have some of the information, but not all the information, but you're still going to give us your opinion anyway. So I try to get people in and say, all right, even if the call is only 10 minutes, we're getting together. Because they'll say, hey, these calls are getting slower. We've been doing this for 11 months now. We're still getting together till we feel very sure that we can hand this off to full operational mode. And it takes commitment, and we don't get it right all the time. We have our bumps and bruises from those as well, but we've done more right than we've done wrong. Some of our acquisitions have done spectacularly well, particularly the product extensions in the back office on the GP side. That has worked really well for us, and we'll continue to do that. But again, 90+% of what we do is all organic growth. That's the main driver. That's how we built Dynamo. And importantly, that's how we have one code stack and multi-tenant environment, one code stack that runs our software. And so we own the code stack, we built it, and so we can adjust that. And as we buy companies, we start to migrate them over and adjust, not with guns at their heads or forcing them, but over time. And we're happy to take a long time to make our customers happy. But we are driving towards the Dynamo platform and what we're building there, because we know it's 1,000+ customers that use it around the globe, and there's a lot of inertia from that platform.
And does that process help you clean up a lot of the technical debt when you acquire a new business?
Yeah, and there is a lot of technical debt. There's a lot of things you can't just shut down immediately, and you have to go about this in a thoughtful manner, including having a CTO, CIO that really understands this problem of, if we just move things around, how disruptive would it be? So I tend to be a leader to help push it forward. The competition right out of the gate is going to say, they're going to force you to convert. It's going to be very disruptive. Since you're going to do that anyway, why don't you come talk to us and we'll give you an RFP, or we'll show you a process, a proof of concept, and move you over. We never have taken that approach. Number one, of taking that with competitors and their customers. But two, we just don't approach the idea that we're forcing people over rapidly. We nudge them. We want to say, here's the benefits. Here's what you're getting in the Dynamo platform that a 5 or 10 million revenue company or something doesn't get with the size of what we are. And so you're going to be stepping into a broader platform. Will there be gaps? Yes. We'll try to address those gaps over time, and we do. That technical debt is incredibly important to run through, understanding where the platform is, when migration makes sense versus when you stand still and say, it's okay, we can live with this for now. Let's keep building where we need to at Dynamo.
Interesting stuff. Could you talk a little bit about the sales process and maybe how it is today versus when you started at Dynamo?
As cloud has advanced in its acceptance in the market over the last 15 years, our ASP, or average sales price, has clearly moved up because the enterprise market has come in, or larger entities have embraced this and said, okay, well, it's not just a $20,000 point solution, for example, or $40,000. It's a 6-figure, 7-figure type deal. And that's a benefit to us. And so I think over time, we certainly focus on the emerging market manager still. We have teams that reach out to them. We have a product that express versions, simplified versions that may make sense, or how they configure it, all the way to the full stack, front, middle, back office implementations that someone may want and need. And so that trajectory is built over time. When I started, we tended to be more front office oriented, and we've extended both with our roadmap and through the product extensions I mentioned into the mid and back office, and those have been quite successful. So now we have a whole solution software stack and see how we move front, middle, back office, and why that's very interesting for larger customers and smaller, because they can use us for a lot of things, versus see where we were 10 or 15 years ago. We were battling, what is cloud? Is it safe? Okay, how about I try this as a tool and I'll give you $20,000 from an annual recurring contract. So it's morphed quite a bit. I'm very bullish on cloud. I think most people are at this point, and it's been a nice market to be part of, particularly if you pair it up with alternatives, which is growing leaps and bounds as well. That has helped in the whole push, particularly into the enterprise, as we think about customers globally, as well as in our home market here in the U.S.
And I want to turn to brand. I think in the market, brand is so important. Does that help the sales cycle?
Brand does certainly help. We've hired a chief marketing officer. She does a great job on a whole host of branding activities, from webinars, outreach like this, and podcasts, to online activities, just things you see on our website, our trust center, a whole host of partnerships that we have online, all towards branding and SEO type activities. We want to get the organic things that are driving leads to us. Branding is certainly a key component of what we do. The sales cycle, it helps that people know us, particularly as we go to international markets and we show up in APAC or in Europe or elsewhere, and they say, oh, we've heard about Dynamo. We know about Dynamo. We just opened up, for example, Dubai about 1.5 to 2 years ago. As you enter a new market like that, really interesting to see how people either know who you are at Dynamo, who your partners may be, because we partner with other folks, like maybe on the data provider side, and they say, oh, okay, they're partnered with someone we know already. That's a big part of the branding. And then what that does, it helps shorten the sales cycle. And LPs can tend to be a little bit longer sales cycle because they have the arc of time with them as well. They're investing across investment cycles, invest across multiple asset classes. And so decisioning can be a little bit slower, but they tend to be very thoughtful and very sticky once they're with you, which is very helpful. You maybe look on the GP side, and sometimes it may be a very fast sales cycle. Maybe someone just wants a deal management tool to help manage their pipeline. Well, deal guys tend to move very quickly and say, okay, let's get that in-house and just get it up and running. We got a good range of sales cycles that are 1, 2, 3 months, as well as ones that can go 9 months or longer, depending on the size of the deal and what they're doing. We do try to manage that, though, so we're not wasting our time with customers and potential customers, and making sure the sales team is asking the right probing questions and the right closing arguments to see where they are in the sales process as they move along. But it's gotten better over the years, even as we've moved into larger deals, just in terms of how we manage that on a structured basis. And of course, at heart, we are a CRM business. So just like our customers use Dynamo, we use Dynamo. This is how we manage our sales cycle. We use our own software. We're very sophisticated users of it, so we can see which customers and potential customers are moving along the pipeline, where they may be getting held up. We do like using our own software in a range of different areas, and this is certainly one of them. And I do get a kick when I get outreach. And again, I'm in software, so I'm sure we make these mistakes as well, but I'll get inbound emails from folks in the industry and say, well, which CRM are you using? Well, we're using ours. So that's been helpful. And the other thing I would add is, as I mentioned in 2017, Francisco invested in us. In 2021, Blackstone also came in, Blackstone Growth Fund. They've been great partners as we think about the sales cycle and think about growth drivers. The team, largely West Coast based and in London, has a global perspective and very sophisticated in software. And so that has been helpful to have both the PE backers with a lot of data points around the globe in the various markets, particularly alternatives, they can bring to bear with us.
Is there a case study or a use case that you like to share with people on what's the right way to actually go through a decision-making process as a client? So I'm a client. I come to you and I say, hey, how should we think about bringing this on board? We need to get adoption. We need people to really lock arms on this because it can slow you down.
One of the benefits of having a cloud stack is it addresses a lot of the needs that a private equity firm or a venture capital firm, real estate firm, hedge funds may need. The challenge with that, which is what you're rightly raising, is, are you a kid in a candy store and you say you want it all lit up all at once? You go in, you go, oh, we got a problem there, I'll take that. Oh, we got a problem there, I'll take that too. And so oftentimes in terms of the playbook mentality that you're raising or what case studies you show to folks is identify those groups that you think are most likely to address this and be open to change, because a lot of folks aren't. And 2, pick your points inside of those, because you have to, in addition to technology, bring in operational change. They need to change their business habits. Who's willing to change business habits? It'll depend on which group you're talking to. Sometimes in the back office, much more open to changing habits if it works really well. Those folks can be very open to change as long as the numbers are correct. If it's repeatable and it works, that's great. You go to the front office, sometimes the deal folks, now I used to be a deal person, might I suggest that sometimes they're high strung, they're under a lot of pressure, they're working 80 to 100 hours a week chasing deals. They might just be happy with Excel and Outlook. And so to get them to come off of that and say, hey, you're going to come try something a little bit different. And maybe they only want to do 2 or 3 or 4 things a week in there, and that's it, because otherwise they have underneath them a whole pyramid of people. analysts, associates, VPs, principals, whatever, doing all sorts of activities. So we really like to assess which groups might be most interested in change, those that maybe have a motivated interest to do that. Maybe it's the back office accounting I mentioned, or let's say you're in investor relations and your job is to be constantly out in the market raising capital from limited partners. Well, if we can make your job easier, more efficient, you follow up with email campaigns, the outreach. When did I talk to this last person? Did I go to Germany? Did I not go to Germany? Did I go to England? Was I in Singapore? All that's captured in a CRM. That makes their life a lot easier, and they might be more amenable to a change. So we like to start smaller and then expand.
You hinted at the future. What are you thinking about and where are we going?
It's a lot of fun to be in software because you get to sit around and think about this with smart people because it's a fast-moving industry. And so we have these discussions at our annual strategic offsite as well as throughout the year. One of the big ones right now, of course, is AI. And I did see in the Wall Street Journal a couple of weeks ago the number of references of AI in the press and on quarterly earnings calls, et cetera, is just through the roof. And it started at about 3 quarters ago. So everyone's talking about AI. We spend a lot of time with the future of how it would impact us in 2 ways. One, more alpha-oriented, maybe what our customers could really use to help them invest more successfully. So AI engines, not necessarily investing bots that know where to go to deploy capital, but pieces of the puzzle, pieces of the process that you could streamline, whether it's Gen AI to summarizing emails, for example, all the way to the productivity side. So that was the alpha side, like how do we create more alpha in our returns, to the productivity, which we focus on how we could help customers in their own operations internally. That's very important. Now, most of the AI things that I've seen so far in the alternatives market has been more on the productivity side to date in terms of tangible activities. You certainly can look at alpha type ideas of where AI may come in and disrupt entire industries, et cetera, and how this could help your particular investment do better. But on the productivity side, helping people get through their own emails more readily, helping them sort through the massive amount of information and looking for data patterns, whether it's predictive AI or machine learning, which we've been doing for years, like in interpreting emails, or some of the more processing heavy Gen AI activities that are out there now and are developing. And I think internally, a lot of firms are going to want to learn how to do this. We certainly have taken that approach at Dynamo. We lead first with how we can develop things that would help our customers on the processes that we're running today. For example, we're mostly a software company, but we do have a service called Dynamo Data Automation, which is taking all of those PDFs and capital calls and distributions and materials that GPs send daily, quarterly, annually over to LPs. They all show up in portals or email inboxes, and we've got a nice video on the overwhelming nature of you wake up every day and you got another 100 emails from all the different investments you have, and then you come in tomorrow and guess what? Now you have 105. You come the next day and you got 110. It just keeps growing. So how do we streamline that for the limited partner? And we have a service that helps us provide that information, convert it from unstructured data to structured data that feeds our software. Well, AI is an important component of that, along with templates and along with a host of other things, machine learning that we do across our stack to make that more real and tangible. Now, the reason I highlight that is I look at AI, I do think it will impact our industry. I tend to focus on near term instead of thinking about the world falling apart. What is most relevant for us now? If you were to say, is it more relevant to think about revenue opportunities right now or internal product enhancements and efficiencies for our customers? I think what I've seen so far from an AI in terms of our developers and what we're doing, it's much more on the latter in terms of being able to pinpoint things that are data-centric, process-oriented. They repeat themselves so that the AI, the LLM, can actually read data and come up with answers that make sense. We're all familiar with the parlor tricks, ChatGPT, your 20-year anniversary is coming up, write me a poem, as well as think about Gen AI and how this could be used from a revenue enhancement opportunity, maybe more near to medium term versus what we're doing today. So AI is important for us. I would encourage each of you to think about that. I do think it's important to ask what your peers are doing. I was at a conference a couple of weeks ago and with a bunch of CEOs, and I asked, how many of you have AI efforts, a group of 20 people, call it, and how many have 0 to 5 dedicated AI developers? How of it's less than 10? How many of it is dispersed through your teams? You have the various development teams that are starting to say, hey, some of these developers, maybe pick one or two teams that are going to come start interacting more with AI. Maybe it's code review. Maybe it's QA review. Maybe it's code development, whatever the case may be. And I think on that spectrum, you find a lot of folks, but no one, except for one outlier for a good reason, had 25 to 30 people. Most people were 5 and under, 10 and under in terms of AI developers that were writing the LLMs, I call it. They're not in the core LLM development, but they're the ones, as John Stewart laughs, are they just writing prompts in? Well, it's more than that. Questions, querying. No, you got to figure out how to query, what the responses look like, match it to what data that you have to make sense. But does it read tables? Can it read charts and graphs? All of those things come to bear, and I find them very interesting. But it's early in the game, 18 months in, and I'm encouraged.
Yeah. Do you think we'll get to a point where we're not reliant on the PDF at all? Something else is going to come in and step into that because there's so much friction in our business as a result of that one tool that we just accept as fact.
Change comes slow in this industry in a lot of ways, in financial services in particular. Will there be other unstructured ways to preload, say, into a portal? So, for example, we have a portal product. And so if the general partners, instead of putting into a PDF, would then just take the data and we help them with templates and just load it into our portal. That way the LP would log on to the portal, just like you would to get your checking statement from Bank of America or Wells Fargo or JP Morgan. Here you log in and you get all of your alternatives investments, where the capital calls are, distributions. So there is an argument for that. At the same time, general partners are under a lot of pressure to perform across hedge funds, private equity, venture, real estate. And so PDFs are easy. And if they can offload it to the LPs, if that's a fair way to say it, or say, hey, this is easy for us, it's standardized, it's structured, you can read it, it's clear, take it here. So I think that'll take some time. There's been a 20 to 30 year debate on whether GPs and LPs could get together on one marketplace and just start sharing all the information, just like secondaries deals. You could get one marketplace, just like the publicly traded exchanges, New York Stock Exchange, NASDAQ, and whatnot, and the secondaries deals go back and forth between each other as the curtain comes up to see who's buying the LP interest that you're selling. Sounds good, and I'm sure we'll get there one day, and some companies have made progress there. I wouldn't want to imply otherwise, but it's been years in making. So I don't worry as much about that happening tomorrow, but I certainly agree that structured data is helpful, particularly as it feeds software like us, because it makes it a lot more user-friendly for the front office and the back office to get all those capital account statements, the transaction balances, all of that standardized so they can see it in software instead of in an unstructured PDF document.
Hank, this is really good stuff. I appreciate all your insight. And 2 closing questions. So one is, any advice for an emerging manager when it comes to technology?
We were emerging software companies in the industry. I certainly can appreciate some of the stresses that emerging managers go through in terms of focus and how to get the capital raised and how do you get the funds launched. So number one, needless to say, prioritization. When we hire people, I understand everyone's going to say they know how to prioritize, but I try to paint a picture of, you've got 50 things to go do. Walk me through how you start to do that, because I don't need to hear about all 50. We all have 50 or more. It's how do you prioritize to get the top 5? So what are those as an emerging manager that you need to think through? Second, I do go back to something I've thought about it throughout my career, the linear line versus the volatile line. The highs are never as great as you think, Hulu Holtz would say, and the lows are never as bad as you think. So the linear line just doesn't exist. We're trained to think that way in certain ways in high school and college. You have a set number of classes, you learn those classes, you get good grades in those classes, all that's good. But the world is very much a volatile place and a lot of ups and downs, so you just got to get used to it. And third, look for partnerships. We've done a nice job here at Dynamo. I mentioned a couple earlier. Other ones like an investor, since emerging managers, the topic. One of the ones we've recently partnered with, Dakota, on the data side. They bring a lot of relevant information to bear for investment professionals in the IR front. Things like that. You can augment what your offering is or bring information from Preqin, a whole bunch of other things that can tailor your efforts and short circuit the time of trying to do it all yourself.
A lot of good insight here. And then the other question I have is, what is the one book, could be an article or other resource, you commonly recommend to others?
That's a good one. So I usually get this question in the form of, what keeps you awake at night? I guess I'd answer it this way. I think of it as sequencing and pacing your reading that way. Now, what do I mean by that? Get your daily feed, get your weekly feed and your quarterly feed. The daily feeds I read PitchBook daily. Preqin has things that come at me and keep me abreast of really what's going on in alternatives. 2, I'm old school, so I still read Barron's. I still like the weekly digestion of information over the weekend. For example, they just had a great article on NVIDIA AI, the chips, and how everyone was trying to catch up with NVIDIA. And then third is the quarterly review, so I can step back from the fray and just say what's helpful there. I'll plug the Harvard Business Review, even though I went to a different business school. We compete all the time with them, but HBR is a good quarterly review. I'll pull things out from there from time to time. Again, the sequencing of what's day to day. I'm firing off emails to my team. Have you seen this? Here's what this team's doing, to the weekly, to the quarterly perspective. So I think that's broader than you were asking for, but I don't have a silver bullet. Just like I don't have a silver bullet for what keeps me up at night. I start first and foremost with my 4 kids, and then I go on to cascading other things of things that you worry about.
Hank, this has been really good. Appreciate everything and look forward to staying in touch.
Okay, thanks, Scott, and have a great day.
Thanks for listening to the show. If you like what you heard, hop on our website at capitalallocators.com, where you can access past shows, join our mailing list, and sign up for premium content. Have a good one, and see you next time.